You're listening to the Breakaway Wealth Podcast, the show that helps you build wealth faster, think outside the box, and break out of the herd. Here's your host, Jim Oliver.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and with me today, my co-host, Nick Costco. Welcome, Nick.
Hey, thanks a bunch for having me. We're going to dive into some almost like misconceptions and things that people don't know about life insurance and how it pertains to building a policy that's ideal for infinite banking. And I remember long ago you saying, hey, by the time I'm done with these next few minutes, you're going to know more than 98% or 99% of life insurance agents ever learn getting their license. And as someone that my journey of having my license long ago, long before I ever knew to teach infinite banking, you're absolutely spot on. So we're going to dive into some truth today.
You know, absolutely, Nick. Sometimes we think about the basics as, oh, well, everybody's heard this, right?
Yeah.
And we did this during our live meeting on Monday of this week. And by the time this comes out, it'll be a few weeks out. And it's just, again, it's a reminder that we can't go over the basics enough. And I know I've said this a million times, but I'll keep saying it, is when I was in my 20s and I was listening to Tom Hopkins. And Tom Hopkins, you know, because I thought, well, I'm a financial planner. My job is to get people to buy my Wall Street products so that I can get assets under management and sell life insurance in a traditional way and disability insurance and all annuities and mutual funds and managed money accounts and all this crap. And not crap, but you know what I mean? And it was a sales job. So I was listening to the best sales trainer I could find, and that was Tom Hopkins. But one thing that I learned from Tom Hopkins is that it was really about educating people. That's how people that were top salespeople really did it. But he would say something. He would say, a champion goes back to the basics at least once a year. So I think that we need to go back to the basics just in our thinking all the time. And when we go back and we read Nelson's book over and over and over, we always, even today, get something out of it. So, let's just dive in, and I'm going to share my screen for everybody that's watching this. And forgive my handwriting, but it's I could make this some kind of pretty PowerPoint presentation, Nick, but then that's just not our style.
Well, we had that back in the day, and you even had it where it moved and all these things, and in all honesty, it was almost a distraction, right? And you know what though, for everyone, this is right out of Nelson Nash's book. Jim's brilliant and all, but he's not smart enough to come up with this completely on his own. So Nelson had this brilliant epiphany about something that he already had. He was financially very literate. He had been putting money into cash value life insurance for a number of decades when he had this epiphany about the power of what he already had, which led him down a path of absolute discovery of all the nuts and bolts of it and why we would do this. So infinite banking is about a process, not a product. But then why is it that the most ideal platform is this very specifically designed dividend paying whole life policy? And why does every example in Nelson's book look extremely similar within a couple percentage points of these ratios? And so the reason why what Jim's going to show today is so important is because, hey, this is why we construct this. And Jim's going to dive in and do this in just a number of minutes.
Sounds good. All right. So what we're going to look at today is the spectrum of efficiency for cash value in life insurance. Okay. Now I can spell efficiency and cash value, but trying to make it
with flashcards.
With flashcards, I'd have to have some cheat stuff up here, right?
Yep.
Trying to get my cameras backwards, audience. So it's like driving me crazy today. All right, so we're going to start off with the easiest part of this efficiency. And we're going to start off on the least efficient from a cash value perspective. Again, spectrum of efficiency for cash value in life insurance. The least efficient is where I would put in $1 and I would have $0. That's very inefficient. But I would have a ton of death benefit. Okay, and what's that called, Nick?
Term insurance.
Term insurance. And, you know, for so long, these financial entertainers like Dave Ramsey and Susie Orman, they would tell you that's what you need to buy is term insurance because you don't need life insurance forever. What kind of concept is that? But what they don't tell you is that term insurance has just one benefit, death benefit. And so you have to die to get anything out of it. Seems like that's kind of harsh. The other thing is that what they don't tell you is that when you buy term insurance, are you betting with the insurance company or against them?
Betting against them.
You're betting against them. Now, they have something on their side called actuarial science. Okay, now actuarial science is all math. If you said to them, okay, and I'm going to give away my age here, that there was 1,000 kids in my graduating class in 1983 from high school, okay, and it was in this zip code, they could tell you in a matter of minutes how many of those kids out of 1,000 are dead, right? Now, Nick, we kid around and we say the best actuaries are from Sicily because they can tell you who's going to die.
Hat tip to Nelson right there.
That's a hat tip to Nelson, right? He would always tell that joke. So, but in seriousness, it's not a guess. It's science. It's math. Okay, so why would you want to bet against somebody that has that on their side? You wouldn't. You would want to bet with them, right? Okay, yeah. So term insurance, 100% cost. Put in $1, you have $0. My $1 is gone unless I die. And then I don't get it, obviously. My beneficiaries do.
Well, and one other thing, term is not the worst tool in the world. It's just not a tool that we can use to solve the problem that you finance everything you buy. And Jim has highlighted a couple of times, but I want you to hear, it's about cash value, right? Cash value is what's going to help us solve this problem and do the process of banking.
So yeah, Nick, you bring up a good point. I'm not bashing term. I'm just saying from a cash efficiency standpoint, we use term at the right time. But like you said, it's a tool. With everything, you have to understand the tool. If I'm taking a sledgehammer and I'm trying to do finish work on building, refinishing my basement or something, then it's really hard to use the wrong tool for a job, right? And have professional results. Yep. So you have to understand what you're getting into. So that's term insurance, 100% cost. And the only way to really make it work to your benefit, the best, is you sign the contract, give the company a check, go outside and get hit by a truck, and then you win. It's a tough way to win, but that's how you win. Okay, so that's the least efficient. The most efficient is something where I would put in $1, I would have $1, so there's dollar for dollar, and I'd have a little bit more than $1 of death benefit. When I say a little bit more, I mean $2 or $3. It depends on maybe $10. Depends on how old you are, what's your underwriting class, are you male, female, all that. But if I put in $1 and I have $1, what's my cost?
$0.
Okay, so this is called a one-pay policy. Okay.
What's it called? What's it called generically in the marketplace?
Well, it would be called a single premium policy back in the day.
Yeah.
It would just be, you'd just write a check for $100,000. You would have $100,000 of cash, and you'd have a little bit more than $100,000 of death benefit. Right. Okay. So the government, though, they looked at that and they said, okay, if I put in $1, you have $1. Wait a minute. You're just doing this for tax purposes. You're cheating the tax code. You're not cheating it. You're taking advantage of it. You're using it, right? So they said in 1986, hey, this isn't life insurance. But we got to give our friends and quite frankly ourselves enough time to get as much money in these things as we can. So we're not going to implement this new law, this thing that I'm going to show you in a second, until 1988. They gave people 2 years to buy these things. But after 2 years, what came into effect was this line somewhere by close to the most efficient, 75% of the way there, something like that, 60% of the way there. And it's called a MEC line, modified endowment contract. It means that if this cash relationship, how much I put in and how much I have, is too efficient, then on this side of the line, it acts like a qualified plan with all of the rules, taxation, penalties, very similar to a qualified plan like a 401k or an IRA. Everything on this side of the line is considered life insurance, okay, with all of the tax benefits of life insurance. Now, whole life and universal life, they're both somewhere in the middle, okay? We're not going to touch really on universal life today because it's by term and invest the difference in a bucket of something, right? An index bucket, a variable bucket, interest rate bucket. It's going to come back now because interest rates are high. It's just going to be plain old vanilla UL again. All right. But this whole life policy that's somewhere in the middle, with some companies, the companies offer something called a paid up additions, where I put in $1, I have $1 of cash value, and I have a little bit more than $1 of death benefit. All right. Well, again, what's my cost on that paid up addition? Zero. Okay. It is a one-pay policy. It acts just like it, but it's only available as a rider on certain whole life policies.
Hey, one quick thing is generically in the marketplace, you'll see PUA used. All these carriers that everyone's using, they'll have some little variation on that nomenclature. So just know that Nelson uses the term PUA, paid up addition, but if like you see FPUR or LPUA, like that's what it is. Okay.
Yeah. That's all marketing and hey, we got this exclusive thing and
sure,
it's kind of noise, right? But I can combine this rider, Nick, this paid up additions rider with a base whole life policy, and I can get its efficiency to get all the way over here next to this line, this MEC line, without crossing it. Okay. And so in Nelson's book, Becoming Your Own Banker, Unlocking the Infinite Banking Concept, he shows that you can get about 40% in the base whole life policy and about 60% in the paid up additions rider. That will get you right next to this line if you don't want to use a term rider. Okay. Now, this term is available as a rider too. And you're going to see on YouTube, Instagram, TikTok, these people that have not done infinite banking very long because they obviously don't understand. They're not following Nelson's teachings. Okay. But what they're going to say is, no, Nick, Jim, that's not how you do it. You want 10% here and you want 90% here, and we'll put a big term rider on there. Now I'm going to show you in a minute why you don't want to do that long term. You're going to start off first, but you're not going to end first. Okay. All right. So let's look at this 60-40 and how it works. Okay. I'm going to just use $100,000. And the reason I do that, Nick, as you know, is we want the percentages to be evident, easy, right? I went to public school. I want this stuff to be clear as day. So that means out of our $100,000, about 60% can go in the PUA, and we're going to have 40% go in the base whole life policy. Okay. Now I'm going to just go out 1, 2, 3, 4, 5 years, and then I'm going to jump to 10 to prove a point. Okay. Now remember, in the paid up additions, that 60%, it's dollar for dollar. It's just like your checking account. So I put in 60 grand and I have 60 grand. I put in 60,000. I have 60,000. Every year that I do this, it's the same. The ratio is the same. I could do this until my hand's tired, but I'm only going to do it for 4 years, and I'll show you why in just a second. Okay? So it's always dollar for dollar. Now, I'm going to show you right now why Susie Orman and Dave Ramsey, those financial entertainers, they are not advisors, they're entertainers, why they don't like whole life. And they look at it really from the beginning, okay? Is in the beginning, the first year I put in 40, I'm going to have about 2. All right. And they go, where'd my money go? Now, if you stop analyzing it at 1 year, remember it's called whole life, like you keep it for your entire life, then they're right after the first year, because I put in 100 and I have 62,000. Okay. Somewhere in that range. You could say 60 grand. It doesn't matter. But the next year I put in 40 and I'm going to have around 35,000. So that means I put in 100 and I've got around 95,000. Now remember, I've got this death benefit that I would have to buy term insurance for. But so I'm going to call this breaking even. The next year, there's a little bit of an anomaly where I put in the 40 and I've got 35-ish again. Okay, I'm just going to make it even. Again, I got the same death benefit. We'll call that even. Now, here's where it gets really cool. The following year, I put in 40. I'm going to have like 40. Okay, so that means I'm going to put in 100,000 and I'm going to have right around 100,000. Again, this is somebody who's got good underwriting, everything else. Now we're definitely even, and we have the death benefit basically as an ancillary benefit. All right, at this point in year 5, I put in 40 and I start to leverage. Maybe I have 45. All right, I put in 40, I have 45. Why would I ever want to put any money over here where it's dollar for dollar when I have leveraging money? Right? So now I'm going to stop making these contributions. And every single year of my life, it's going to get better and better and better, that ratio. And by year 10, and right now with even low dividends, it's better than the number that I'm going to write up here, but I'm going to make the math easy again. You're going to put in 40 and you're going to have more than 60 to use. All right, so let's stop right there. You write me a check, Nick, for 40 grand, and I turn around and write you one for 60. Are you okay with that?
Absolutely.
Okay, so when you write that check, if that's the ratio, do you want that first check to be big or small?
As big as you'll let me write it.
Right? If I would let you write one for 4 million and I gave you 6 million to use, would you be okay with that?
Absolutely.
Okay, so let's go back to our internet marketers, okay? Remember what they said is they said put 10% in the base whole life, 90% in the PUA, have this big term rider that is what? Cost. And they said, Jim, the MEC line is tied to the death benefit. So we put this term rider on there. We can move this MEC line over here and we can get 80 to 85% cash value in the first year. Now, why 80 to 85 if we're putting 90% in the PUA? It's dollar for dollar because we got to pay for this term policy. And what they don't tell you is that you have to keep that term policy on there for 7 years after the last PUA payment. Okay, 7 years after that. So think of the cost there. Okay, so then they get down to this point, right, at year 10, and they can write a check for 10 grand and get 15. Well, wait a minute. Isn't that the opposite of what you just told me? Yes, they're at 80% this first year. Do you want to start a race first or do you want to end a race first?
I'd love to finish first.
You want to finish first, right? Now, it's funny because it's over your lifetime where everybody spreads out. In a 100-meter dash, they used to call it the 100-yard dash when I was a kid. In the 100-meter sprint, I think is what they call it now, I can't remember, there's almost a photo finish for some place in the race almost every time.
Yeah.
But did you know in the Olympic marathon, there's never been a a photo finish.
I didn't know that. Yeah.
Because your behavior over 26 miles, right? It spreads people out, and people separate. The cream rises to the top. Your behavior over a long period of time will separate you more than your sprint in the beginning. Okay, so, let's go back to this efficiency thing. When people are taught about life insurance, and I used to teach the courses so that you could get your CLU, which is Chartered Life Underwriter for the life insurance business, your CFP, which is a Certified Financial Planner, which is, I guess, for the financial planning business for Wall Street, right? And what we taught people was not this.
Right.
What we taught them was human life value, the projections in universal life or variable universal life, buy term, invest the difference, and do it in a tax shelter like universal life. It was all where the risk is on the client.
Sure.
Right. Now, the insurance company, remember, they have actuarial science on their side. So why wouldn't we want them to take the risk? They're built to take the risk. They're doing the math.
That's right.
So we don't know. We don't have actuarial science. Why would we take the risk? That's why universal life is not what Nelson would recommend for infinite banking. Okay. But when you look at this, what I just taught you, now you know more than 90% or 99% of life insurance agents when it comes to using a life insurance contract for infinite banking or using it for cash value. And we haven't even talked about infinite banking. None of this, what I just showed you, is infinite banking.
Yeah, we haven't
just
put it to
money
work yet. Hey, yeah. Can we, there's something else that creeps up a lot that you have on the screen here is about this term rider.
Yep.
And there's this is tossed out all the time. Hey, yeah, it's expense, but it's convertible. and so I want to share that there's an issue here, and there's a little backstory to this that I'm going to kind of gloss over, but the reality of it is, to the letter of the law, it is convertible. Okay. But Jim, I remember a number of years ago, you were helping educate some of our competitors, okay, our friends in the space. So, and most people don't realize this about you, but you're really brilliant with the math and the behind the scenes about how this is all constructed. And I'm not going to spoil it here. I'm going to let you say it. But what happens, Jim, if you were to go convert that term when it's all bundled together like this?
If you convert the term, then you mech the policy.
Well, why's that?
Because what you're doing is, when you convert the policy, you're not adding to this policy. You're converting that term rider to a separate policy. So what happens to the death benefit that the term rider is providing here?
Yep.
Is it's gone. So remember, you're going to use it to move the mech line, but then the mech line is going to move back on you.
Yeah.
And when the mech line moves back, then you're in trouble. So it's not convertible. Yeah. Or you could convert it, but you'll mech the policy. And Nick, something else is, we've run into people, even in the last few months, that have mech policies that they didn't realize were mechs.
Yep.
So again, I don't think people climb Mount Everest and freeze on the way down because they have a death wish.
Right.
But they just didn't have the right Sherpa, or they took risks that they shouldn't have taken.
Yeah.
And so a good Sherpa would say, no, we're not going today. I've seen this weather pattern. I've seen this mountain look like this. That's a death trap. We're going to wait.
There's a thing in aviation called a sucker hole. And those of you who didn't know, I used to fly airplanes for a living. And you know, before you're capable of flying around in the clouds, you'd say, oh, there's a hole in the clouds. We'll just go up on top and we'll do our air work, and we'll just come back down through that hole. Hey, if you don't know better, you just got to count on that hole closing up, and now you're stuck above the clouds and you don't know how to get down.
Yeah. And you know what? That's a great example. the other thing on conversion and the term rider and everything else is sometimes that term rider isn't convertible to the best whole life policy.
Yeah.
Right. And so even if you could convert it, you're not going to get the best policy. Now, why do companies do that? Well, that way they can make the term rider cheaper because they're not giving you that option. And so there's all these little tricks and all these little hurdles that if you haven't done it before can trip you up and can make you not as efficient when it comes to building your own bank and your own infinite banking system. And it's one of the reasons that when I see brand new people that like know how to market, that they've not done this, makes me cringe because, you know, we have to go in and fix it. It's like going, and it's like being a really, really good contractor and people calling you and saying, hey, I had somebody install floors and they creak and they're, you know, uneven. And you say, hey, I'm sorry, but like, we can't save those. We got to rip them all out and start over.
Yep. Yeah. I mean, I love it. We had a great friend of ours analyzed all the policies in Nelson's book, and every one of them comes up within a couple percentage points of 60% going to the PUA, 40% into the whole life. And there's frankly just a great reason, because it helps us solve the problem of our need for finance. And it's, hey, let's build this the most efficient way. Nelson's shown us that path. And then how you go do banking, there's literally infinite possibilities. And Nelson outlines it perfectly on the top of page 14. He credits Einstein with the quote that imagination is more important than knowledge. And we're here to help you, serve you. If you haven't joined our online community, go to createtailwind.com. community.createtailwind.com. Join for free. We've got great master classes on there. There's some free content on there. If you want to reach out and talk to one of us and help unlock some of the content on there that'll walk you through this in greater detail, we're happy to do that. Or you can just go to your smartphone's online store there and type in Create Tailwind, all one word. You'll find us there. And we're here all day.
Oh, that's awesome. And, you know, Nick, sharing these basic things, which we're going to do over the next few months, and we're going to pick a page in Nelson's book and really explain to people what this page means.
Yep.
Because there's not a wasted page in this 92-page book. If you haven't read Nelson's book, reach out to us, because not only will we help you get the book, but we'll guide you on that community to a course where we explain all the important pages in that book. And I promise you, if you read the book and then watch the course, take notes, ask questions, send us questions, get on a call with us, you'll know more about that book than 99% of IBC practitioners out there when you're done.
Yep. Yeah. Well, thanks a bunch for sharing your wisdom. I get to hear it all the time. And we're blessed to hear all that and equip people with how to move forward along their education path.
Yeah. Awesome, Nick. Thank you. And audience, we're going to end this podcast just like we do every podcast with the incredible words of Earl Nightingale. Take it away, Earl.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Thanks for listening to the Breakaway Wealth Podcast. Be sure to subscribe to this show wherever you're listening so you never miss an episode. If you want to start increasing your wealth building ability right now, go to community.createtailwind.com to join our free online community and get access to free, in-depth training designed to help you build real, lasting wealth. See you next week.